On 10th March 2023, the world was greeted with the news that Silicon Valley Bank, one of the reasonably newer and respected banks in the United States, had collapsed. It was shocking. Since then, in the last 30 days, 3 other banks, namely Signature Bank, Credit Suisse, and Silvergate, are all smaller, medium-sized and large banks that have met same fate. What happened to Silicon Valley Bank? Is that problem going to spread like a contagion? Is Indian banks safe? These are all the questions in our minds. And hopefully by unraveling what happened at Silicon Valley Bank, we will be able to understand how the banking system is going to be impacted, if not already impacted. That's what we're going to see in today's episode. Let's first understand what is the role of a bank. Banks are meant to do 2 things. One is to collect monies as deposits or savings account or in current account from investors. All those monies that are received is then channelized as loans to prospective customers. And the difference between the amount charged for loans and the amount paid to depositors, that differential is the earnings of the bank. That's really a very, very simple business that banks run. Unfortunately, there are lots of small minor details that one needs to take care of while doing these simple transactions. Typically, banks which collect money from depositors either have that money as fixed deposit for periods ranging from 15 days going up to 5 years, or that money lies in savings account or in current account. Money in savings and current account are meant to be repaid to the investor at any given point in time. So the investor can write a check and take the money out. While money is deposited, can also be asked by the investor back, but they are generally meant for a slightly longer period. But one thing is that banks deposit are always on demand, which means the investor can ask for the money at any given point in time. On the contrary, when the banks lend the money, they lend it for periods starting from short-term working capital requirement to long-term loan. Now these loans that they give to customers, they cannot go back to the customer and ask for these loans to be paid back quickly. As a result, as part of a banking structure, for every 1 rupee that the bank kind of collects as deposits or investment into the account, it can only lend a certain portion of it, say 60% of it. The rest of the money, it has to be kept in investments, in bonds, in treasury bonds, and so on and so forth. So that should there be a need for liquidity, it can liquidate those treasury bonds and then pay this. So this is really the simple function of a bank. Now let's see what happened for Silicon Valley Bank. And the problem started more than 2 years ago. At the height of COVID, when COVID was announced, Silicon Valley Bank, like every other bank, was flush with money because the US, at that point in time, the US government did what is called a targeted funding. So they gave money to individuals, employees, corporates for running operations to make sure that their operations were not impacted by COVID. As a result, a lot of these entities had lots of funds at their disposal, which they then channelized into the banks. So the banks, not just SVB, most banks in the US at that point in time were flush with funds. Unfortunately, due to COVID, there were not many lending opportunities. They couldn't lend that money to anybody else. As a result, they had to park all those surplus monies into securities, treasury bills, bonds, and so on and so forth. Now, remember at that time, 2000 March, interest rates was at its all-time low, historic low, maybe close to 0%. Now these bonds which these banks were purchasing were all close to 0% coupon bonds, right? Now this is what they were forced to do because they had no other option. There was no other way they could deploy that money. Now, over a period of time, as COVID started ebbing, what happened is that because of supply constraints and because of this Ukraine-Russia war, you started having supply-side inflation. products and commodities started becoming more pricier, and there was issues relating to supply. And because of that, inflation slowly kept creeping up. The US Fed, equivalent of what the RBI in India is, had to do something to tame the inflation. Inflation, in fact, went to an all-time high, a 40-year high, in fact. Therefore, the Fed started aggressively raising interest rates. Over the last, say, 1 year, interest rates in US have moved almost 4.5%. Record-breaking interest rate hikes in such a very short period of time. Now, what happens when things like this happen is that the bond prices which you have invested in 0% coupon, when those same bond prices go up to 2.5% or 3% or even higher, your bond gets devalued. There is a drop in the price of bond. As you can see in the illustration shown below, the bond prices kind of depreciate quite a bit. This remains unrealized in the books. But this is where the tragedy for Silicon Valley Bank is. While most banks suffered the same consequence, Silicon Valley Bank had one more problem. It had one single type of customer base. The customer base for Silicon Valley Bank were most of the startups in the California and Bay Area side. All these startups, when the going was good, had tons of money that they had parked with Silicon Valley Bank. But ever since COVID struck and during the course of COVID, it became clear that there was going to be what was called the winter freeze of funding, which means that the follow-on funding for some of these startups were going to have a problem, were going to be delayed or not coming at all. As a result, many of these startups started, as interest rates started moving up, had to go back to their deposits with the banks and pull out those deposits. Silicon Valley Bank had a problem. Now, the investments that it had in treasuries were at a significant loss, mark-to-market loss, like I was mentioning earlier. But their depositors were coming back and asking for money. This dual force of a loss coupled with need for liquidity made them sell the securities in spite of a loss to realize liquidity to pay the depositors. This had to be done. There was no other way. The amount of loss was quite significant. And when that got leaked to the market, there was panic. When market knew that such a huge loss got made, they really panicked. And therefore, that accentuated, that increased the flow of withdrawals from Silicon Valley Bank, thereby leading to a collapse of the bank, which became imminent on the 10th of March. The 10 pointers as to how the SVB crisis unfolded. First, the singular customer profile is one of the chief reasons. Unlike other banks where people lend for car loan, personal loan, so on, Silicon Valley largely lent to one particular profile, which is IT and startups, and also collected deposits largely from that same segment. One needs a diversified portfolio base, and that's one of the primary reasons this kind of a problem occurs. Second is high deposit collection, especially during early part of COVID, and low deployment opportunity, because you were flush with funds, but the amount that you could deploy was very limited, and it was very, very low rate that they could deploy it in. Third, high inflation, 40-year high inflation followed the COVID, and as a result, the Fed had to take very aggressive measures at combating inflation, which is why they had to do a very steep increase in the interest rates. That leads to the fifth. The mark-to-market losses because of high interest rate spikes means that the security prices held by Silicon Valley Bank was kind of downgraded, and therefore there was a lot of unrealized losses already in the portfolio. Next, because of the funding freeze, a lot of people who had placed deposits, a lot of companies that had placed deposits with Silicon Valley Bank had to come to access that money because they couldn't raise money otherwise. And a lot of them did it at the same time, leading to the fact that Silicon Valley Bank had to encash their securities despite the MTM losses. 7. Because of all these issues going public, it created a certain amount of panic and negative in the marketplace, resulted in more people coming to ask for money. Because of all these crises and so on and so forth, the receivership of the bank was taken over by the Fed, and therefore, as per the US deposit insurance, initially they promised $250,000 worth of deposit were protected. Later the government came back and assured them that all the depositors were protected under the US law without accessing taxpayer money. That's very, very important. Next, last, the bank's equity stakeholders and bondholders who had invested in the additional tier 1, what is called an AT1 bonds, were completely written off on account of this. While the depositors will be paid based on realizations and so on and so forth, the entire stakeholders, shareholders and AT1 bondholders value of their portfolio in Silicon Valley Bank is considered as zero. Now, are there lessons to be learned from the Silicon Valley Bank collapse? I think the first lesson is that customer profile needs to be diversified. You need retail loans, you need corporate loans, you need other types of loan. Only a diversified portfolio is a protection to the bank. Second up, you need to ensure that all the securities that you invest in is in a place which is liquidable at a reasonable amount of time without a mark-to-market loss. So the portfolio actions that one needs to take needs to be held dynamic. I also thought that understanding the urgency of cash flow, the Fed could have done something like a loan against share for some of the banks. It could have helped them ease the pressure on money. The Fed could have taken over those securities and against those securities lent more capital to the bank, temporarily at least, so that the liquidity could have been sorted out. I thought the Fed could have done a more proactive role, because in India we've seen this happen. When mutual funds went through a crisis a couple of years ago, the RBI opened a special liquidity counter and gave the mutual fund houses a line of credit against securities. I'm sure something like this could have been worked out in the US as well. Having said that, does this crisis in the US have a bearing on other banks? I surely think so. Matter is still up there. Lots of banks are going through a lot of stress in the US, especially on account of all these 4 big institutions going down in the world. But having said that, in India, I think we are in a far better place, primarily because our banks are diversified, our NPAs are reasonably low. Most of our banks, the interest rate spikes haven't been so large in the Indian context. So from that perspective, I think Indian banks are in a much better place, and I don't think something like this is likely to happen in the near term from an Indian banking perspective.